So Sam Hummel is a graduate student at the interdisciplinary liberal studies program at quite prestigious Duke University, which is in North Carolina, USA. I think you've had some storm there going, so you're fine. His research focuses on pathways for monetary system transformation that advance sustainability and social equity. So he has been very active in a few organizations. For example, the Association for the Advancement of Sustainability. Nobody can have anything against that, so that's very good. Or the Sustainable Purchasing Leadership Council, advising organizations in strategies in when and what to buy. Sam is also then very active in the Alliance for Just Money, and has made actually also another presentation. This is not his first one for AMI. That was last time or last year, titled Monetary Crosswalk. And I was very fascinated with it because he was presenting a matrix clarifying the many diverse ways money enters and exits the economy. And I don't know, you can maybe give us a little bit of a update whether you're publishing something still with the monetary crosswork or make something still available. I didn't ask before, but I intended to do so. Anyway, without further ado, today's presentation is titled Currency Federations, How to Kill Hyperinflation and Protect Monetary Sovereignty. And Sam, the floor is yours. Welcome.
Great, thank you. And I will just say that similar to last year, the title has changed since I gave it to you. So in the process of developing this presentation, I realized that extraordinary claims require extraordinary evidence, and that it was going to take me a little bit more focus on the inflation and hyperinflation aspects. And so the focus on monetary unions or currency federations will be something that I'll kind of preview towards the end, but it's going to need to get into it in full, will need to be another presentation of its own, which perhaps we can do as a coffee house or something like that. So yeah, thank you very much. And just to say on the monetary crosswalk, that is available online. It's something that I published last year. I think it doesn't come up in Google results right now because I didn't pay for the domain hosting service, and it doesn't allow Google indexing if I don't keep paying. So I need to put that back on there. But if you contact me, I can send it to you. It is online though. It is actually also linked from my blog, which is samhummel.substack.com. Okay. So the goal of this presentation is to share some discoveries that have led me to conclude that controlling exchange between currencies is one of the most important aspects of monetary system reform. I really believe that. And so why is this important to share with this audience in particular? Is that in conversation with monetary reformers around the globe over the last years, I have seen that inflation is a major concern and focus for us, and it gets a lot of discussion. There tends to be an assumption within those discussions that inflation has a domestic cause, and such as printing too much money, and that there's virtually no discussion of foreign exchange or capital flows as an acute threat to price stability and sovereignty. And most monetary reform proposals themselves, if you read them, do not address foreign flows at all. So, for example, 9 out of 16 that I recently analyzed don't even mention it really. And so this presentation is going to proceed as follows. First, we're going to talk about myths and truths around inflation, what causes it. And then we're going to talk about hyperinflation specifically and what prevents it. And then we're going to talk about why restoring monetary sovereignty requires monetary unions, which are also known as currency unions. And Stephen, just let me know what time I need to be finished by here.
You have, I think it's 1 hour. I'm almost sure.
Yeah.
Yeah, we'll say 1 o'clock or the top of the next hour.
Okay, great. Thank you. So just to start off, because I know this group is pretty specific in its use of language, I want to define a few terms that are important for us. So one of them is that typically currency in monetary reform circles is we distinguish very carefully between cash and coins as currency and bank deposits as a broader category of money. But when you're talking about international monetary flows and foreign exchange, that is not how it is used. The word currency is used to describe all cash, coins, and bank deposits. And so in this presentation, I am going to use the terms currency and money interchangeably. And that is consistent with practice in talking about international monetary flows, where we talk about currency exchange and currency exchange rates and so on. Inflation is a gradual loss of purchasing power due to a broad rise in prices for goods and services, whereas hyperinflation is rapid and accelerating inflation, usually greater than 50% per month. So I'm going to distinguish those, and we're going to talk about inflation first. So I believe that there are a lot of myths about inflation that are perpetuated in the media, that perpetuated in our textbooks and so on. And the good news is that I believe that we can actually sort through those myths and actually find the truths about what causes inflation. So if you look out in the world and ask questions like what causes inflation, you'll run across, in particular, you'll run across the kind of what I'm calling the conventional theory. It's also the quantity theory that inflation is caused by the government printing too much money. This is the theory you've probably heard about the most common in terms of inflation. And I think in monetary reform circles, I think there's a certain amount in which folks in these circles buy into that theory. And that's part of why I want to talk about this, because I think it's important to challenge it. I would argue that the historical evidence, and I would say that this is also a consensus among heterodox economists versus mainstream neoclassical economists, is that in fact there are many things that can cause inflation, not one thing. Right? So as I said, the most common theory is the quantity theory of inflation. And it says, and this is a quote, direct quote from the best-selling economics textbook in the world, principle number 9 out of 10 principles for understanding economics and the macroeconomy. Principle number 9 is that prices rise when the government prints too much money. It's on page 11. This is what we're told about what causes inflation. And by the way, this emphasis or attention on inflation that happens within our monetary circles, I think is appropriate. And it also is a major concern for all macroeconomists. As you can see, the best-selling economics textbook right there by Gregory Mankiw, and it mentions the word inflation 1,067 times. But this story is a big myth. The quantity theory of money has been debunked a whole bunch of times over 100 years. And it just has a bunch of flaws. One excellent source of rebuttals of this theory is a couple of articles published by Blair Fix. Highly recommend them. But it is certainly the case that this is not what describes all, or I would say even most, inflationary episodes. There are two more mythical theories of inflation, I would say. And if you're familiar with economics, macroeconomics, there's something called the Phillips curve. If you're not, don't worry about the Phillips curve. It's just to help you locate where these ideas are coming from if you are familiar with these types of things. But the important thing to note is that, macroeconomics, macroeconomists do admit that there are additional causes to inflation. But they don't mention them until chapter 35, page 745. right? So we get two additional theories of inflation from mainstream neoclassical economists in your principles economics textbooks. The first one is that high employment levels give workers too much spending money and bargaining power. And the result is that you have a wage price spiral in which workers are fighting for higher wages, they get them, and that causes the manufacturers to have to increase their prices. And you just get into this circle that's just terrible. And the only thing you can do is bring up unemployment so that workers don't have as much bargaining power and can't raise wages and thus force prices up into an awful spiral. The second one, which is also only discussed 35 chapters and 750 pages into the book, is that businesses raise prices because they expect inflation. And so, in other words, they're raising prices in advance of the inflation actually happening. And both of these things are not supported by the historical evidence. This claim that high employment leads to wage price spirals, well, none other than the International Monetary Fund in 2022 took a pretty close look at the historical record. They studied 79 accelerating inflation episodes across 19 countries and 6 decades. And they concluded that wage price spirals, at least as defined as a sustained acceleration of prices and wages, are hard to find in the recent historical record. They basically couldn't find one that went on more than a few quarters, that had those dynamics and appeared to go on for more than a few quarters. So that's a myth, I would say. Obviously, other people out there disagree with me, but this is me. These are my labels. This is what I would say about it. The other one is that one that I mentioned, that expectations of inflation are what drive price hikes, right? And in reality, this just doesn't match with how banks or how businesses actually set their prices. They don't raise prices in anticipation of inflation that has not yet occurred. They typically do what's called markup pricing. They add up their costs and then they put 10% on top of it or something like that. And when you're in an inflation, they don't even do that. They actually do the opposite of raising their prices in anticipation of inflation that has not yet happened. Instead, they typically delay increasing prices, choosing instead to cut operational costs so that they can keep prices from rising on their customers too quickly, even as their own costs are rising, right? It's important to note that this whole story about inflation being driven by expectations is a very new theory of inflation. The Bank of England never once issued an inflation target in the first 300 years of its tenure as the most respected central bank in the world. It did not adopt the idea that it should put out an expectation forecast a forecast of inflation with which to manage people's expectations until 1994. This idea really was developed in the 1970s by economists who are kind of obsessed with an idea called rational expectations. So I would also say that this is a myth. So what does cause inflation if I think that these two things are myths? Well, before we go on past the conventional myths, I just want to say that these aren't just conventional myths. These are capitalist myths. They are apologetics and even smokescreens for things that are of obvious advantage to capitalists, the owners of monetary and asset wealth. For example, the government printed too much money is a perfect guise for arguing that the government should be smaller, the central bank should be controlled by bankers, and that the government can do no right. If there is inflation, it's the government's fault, right? Immediately, if you put this idea out there, if there's inflation at all, everybody knows, blame the government, right? Very convenient. High unemployment, high employment, full employment is to blame, for inflation. Okay, if there's inflation, we're supposed to blame workers and unions. If you sell this idea, that's what people will do. It's very convenient. If you believe the idea that expectations of inflation are what control inflation or drive inflation, then you believe that the central bank should be independent and that all of us morons out in the world, should be protected from ourselves, right? So we need to just leave it all up to the experts in finance because they're the folks in the central bank who can do it where we can't. So the historical evidence, I believe, points to some much truer explanations for inflation. First of all, as I noted before, and this is a consensus among heterodox non-mainstream economists, is that there are many causes of inflation. And I'm actually going to run through these a little quickly because I've counted up 14 in the literature and in historical case studies that I've looked at myself. So one of them, which is the most obvious one, is that firms face rising input costs like gasoline prices going up, oil prices going up, and they have to increase their prices, pass those costs on, because they can't do anything else, right? So this is a cause of inflation. Another one is the failure to invest in production, right? This is the idea as population and economy grows, production needs to grow. If it doesn't, you start to have scarcity, and you can have product prices becoming dear. Another one is production disruption. So there's a major fall in production due to a famine or war or something like that, and that during that time prices are go up because of that shortage. But really, that doesn't necessarily have to happen, even in natural disasters, because really it's a result of price gouging. And there are many examples of countries actually for various reasons, and not just countries, but religions and other groups, really putting a foot down on price gouging, especially in the cases of natural disasters or wars, as being unethical. Then there's monopoly pricing, which is where monopolies are able to use their monopoly power, to their market power, to raise prices at any time, not just during disruption. Then actually there's interest rate increases. Believe it or not, there's quite a bit of evidence that interest rate hikes increase prices. And that's because the higher interest rates are passed on to customers as higher prices. A flip one is that low long-term interest rates can fuel the bidding up of asset prices because capitalists can borrow a lot of money at low cost and go to town buying up assets and driving up the prices of those assets. Another one that's in the historical record is increase in luxury goods. But really the correct way to say this is that it's a reduction in the availability of affordable goods. And if you see economists talk about, oh, well, everybody's buying more expensive SUVs, et cetera, or paying, buying luxury housing or whatever, in my community, they're not building affordable housing. They're only building luxury housing, right? So the cost of housing is going up, not because people are choosing luxury, but because the affordable options are going away. Another one is a shortage of financial assets relative to investable cash. So some of you may have heard of, we have asset managers at pension funds and, various places that are just desperately trying to find places to invest their money in order to get a return on their investment. They're not allowed to just leave the money sitting in cash. So they will overpay for real estate or stocks or bonds just because they have to buy something. And this drives up the prices of those assets. Another one is issuance of too much money, and particularly too much money for non-productive purposes. This is clear in the historical record that this can drive inflation, but it's typically attributed to deficit spending by governments. There's no mention made of the fact that banks create money and have also had their fingers very culpably in the mix in many episodes where the money supply was growing quickly alongside inflation. Particularly, they played an important role in funding non-productive purposes. So now I'm going to get to a few that we're going to pay a lot more attention to. So I've changed the color on them. And another one is speculation, especially foreign exchange speculation, right? So this is often fueled by bank loans, where speculators are using leverage, which is money creation, to place bets on the value of a currency going up or down. And as you might imagine, when the value of a currency goes down, it takes a lot more units of that currency to buy something, especially something that's an import, which means that that thing has just become more expensive and the price has gone up on it, right? So currency devaluations that are driven by betting against that currency, driving it down in value in foreign exchange markets, causes prices to go up for all imports. And because many countries are importing oil, which is an essential input into almost every aspect of their economy, when you have a currency devalue, not only do your import products go up in price, but also your domestic products, which have, for example, oil dependencies all in them. So again, devaluations of currencies, this doesn't have to happen because of speculation. So I maybe should have flipped the order of these, but it can. There are other things that can devalue currencies, in particular, what's called capital flight. So for example, in a case study we're not going to get into today of Jamaica, a social democratic government was elected in 1972, and a bunch of capitalists took their money out of the country as quick as they could. And the fact that they were trying to convert their money, at huge quantities very quickly, meant that the number of people trying to sell those currencies on the other side was not as large as the demand, and the value of the currency fell, and they had their first high inflation episode in really the history of Jamaica, at least especially independent Jamaica. So high foreign debts is often also cited as a contributor, particularly in hyperinflations, if you look in the literature. And this is often when repayments of debts are owed in foreign currencies, again, which sets up a great situation for currency speculators because they know that the government has to borrow or has to buy foreign currency in order to repay a foreign loan. They don't have a choice. And so therefore they can bet against the government's ability to do that, essentially. And then the last one is the legitimacy of the currency going away because of the government behind it. So you might think of here in the United States, you can think of many countries in the world where the government fell, and you now find the notes or coins from that government, floating around maybe at coin collectors, but nobody's using them anymore, right? They've lost their value because the entire productive economy, the sellers of goods and services, don't accept them in exchange for things that people actually need, right? And that's often because also the legal institutional infrastructure, the courts, the police, and other things that would enforce that currency's use, the taxation, etc., have gone away. Okay, so I know that was a lot, but I hope that as I was going through those, you recognize that, oh yeah, oh yeah, I have heard of that. Oh yeah, I have seen that, and I hope that the main takeaway, instead of trying to remember all these, is just an awareness that right, this is completely absurd that the main textbooks in economics teach this singular story. And then basically when they add in a couple other stories, they're also bogus, where there's all this evidence of all of these other very clear causes of inflation. Some of which are mentioned in the textbooks, as in, yes, firms, when their input costs go up, they have to raise their prices. But then when you get to the part where they are let's talk about inflation and let's explain how it works, they don't talk about that. Okay, so why are we talking about inflation? Because it's a huge topic in our work. But what really motivates that topic? I would argue that what really motivates us talking so much about it, and not just us, but out in the world, is really hyperinflation, we've all got these pictures in our minds of, women in the Weimar Republic. This woman, I think this is in my social studies textbook in 6th grade, and I remember being like, oh, there's this woman burning notes in the stove because they're not worth anything. Today I think probably people have gotten their textbooks the $100 trillion Zimbabwe, note. And these are terrifying prospects. These are terrifying images. And whenever anyone proposes making any significant change to how monetary systems work, this is what we're told. You're going to turn us into Zimbabwe. You're going to create a Venezuela. This is a recipe for hyperinflation. Don't mess with it. Maybe we've got a little inflation now. Maybe we've got a few problems, but don't mess with things too much, because that's how we're going to get hyperinflation. Especially don't focus on using money's creation to solve any type of services for public good, anything that would be paid for by the government, because that's the royal road to hyperinflation. This is what we're told. This is the genuine, I think, embodied fear, like I have, from seeing this in my 6th grade textbook, that average people are walking around with, right? And it's a major obstacle. It's a major challenge to even getting people comfortable with the idea that we should change anything significant about the monetary situation and our monetary system. So let's look at hyperinflations, and let's look at what really prevents hyperinflation. And so first of all, as I mentioned, hyperinflation, we're going to define this term, but now I'm going to do it a little bit more clearly or more fully. So if you go to Wikipedia, which is not the best source of information on everything, but it's a pretty good example of what the average person is going to find out about inflation when they want to know about hyperinflation. And so it says, the entry, these are all in the very first paragraphs. In economics, hyperinflation is a very high and typically accelerating inflation, with monthly inflation rates over 50%. So if we want to find out how to prevent hyperinflation, we need to find out what's the accelerator. Not just what causes inflation, but what causes accelerating inflation, right? That's what we need to figure out to stop hyperinflation. It also goes on to say it quickly erodes the real value of the local currency. As the prices of goods increase, this causes people to minimize their holdings in that currency, as they usually switch to more stable foreign currencies. Right? So what does that tell us? Hyperinflation has something to do with foreign currencies and foreign exchange. Right? It's right there in the very first paragraphs of the encyclopedia of our time. Okay, typically, however, the general price level rises even more rapidly than the money supply, as people try ridding themselves of the devaluing currency for a foreign currency as quickly as possible. As this happens, the real stock of money, in other words, the amount of circulating money divided by the price level, decreases considerably. Sorry. So this is fascinating. Right there in the explanation of hyperinflation, what it says is the fast rising prices actually means that there's less money relative to the higher priced goods, not more. And this is really important because this explains why it is that governments actually have to print money when they're experiencing a hyperinflation. If they didn't, their population would have no ability to pay for the prices because they're actually experiencing a shortage of money in the economy, not an oversupply. Now, again, you might have noticed in there that it says devaluing the currency, right? And so there's something going on because you can only devalue a currency relative to another currency, or at least that's what's going on in this situation. So, historically, what has been the biggest accelerator of hyperinflations? It's really hard. If you look at the literature and you look at hyperinflation episodes and you try to look at the onset of the inflation, or the onset of even the hyperinflation episode, you will find utter disagreement about what is causing that situation. You will not only find disagreement, you will find also people just throwing spaghetti at the walls. It was this, and it was that, and it was this other thing. And you'll also find people really playing very elastically with the time period. They'll say, it was government deficits because, at this time there was a high government deficit at the time the inflation took off. And you go, well, wait a minute. Actually, if you look at the previous 10 years of that government situation, they were in a major deficit problem for the last 10 years, right? So that doesn't really explain why the hyperinflation took off right here, because it should have taken off at any of these other points in the past 10 years if that was the cause. But that doesn't stop people from presenting that as the cause and cherry picking a single data point to say, aha, see, high deficit, high debt at the moment that inflation took off. So after trying to parse that a bunch, I realized something, which is that it's much easier to find the answer of what's accelerating hyperinflation by looking at the end of the hyperinflation, not the beginning. And again, that's because the start can be messy with multiple factors, but the ends of hyperinflations are often clearer. And I'm going to show you what I mean by that in just a second. So I had the ambition of giving you 3 case studies of this: Weimar Republic, Argentina, and Jamaica. But that is overambitious for the amount of time we have. So I'm just going to give you the Weimar Republic, and with some depth, because it's a pretty big claim to say that the Weimar Republic inflation was not caused by overprinting of money by the government. That is, just the story that's out there wherever you look. And also, there's just a lot of interesting stuff going on in there. And then I'm going to go from there to talking about the monetary unions. But I will say that the Argentina and Jamaica stories look quite similar in a lot of ways. So here's a picture. Again, if you go to Wikipedia, this is what the average person is going to learn about the Weimar Republic hyperinflation, which is that it was really bad. It was just like this exponential growth curve. It was insane. And you will be told, by this date, November of 1923, the mark was worth 4.2 billion marks is what it cost to buy $1, right? Do you notice anything strange about this chart? It took me a while to see it, and I actually didn't see it until I saw what I'm going to show you on the next slide. The chart ends while it's still going up. Why wouldn't it show us the end of the hyperinflation? And it's not just this chart that's on Wikipedia, it's everywhere you look. This is 3 different sources of the hyperinflation in the Weimar Republic, and they all end with the inflation still going off the charts. But here's how it ended. It ended in a couple of weeks in November 1923. This is the cost of living index. This is the wholesale price index. And you can see they managed to make a right-hand turn at basically a 90-degree angle in a matter of weeks. When I first saw this, I freaked out, because this blows away basically every theory of inflation and hyperinflation that I'd ever heard. Most of those things that we talked about earlier, they simply can't act that fast. And so let me, well, there you go. That, if you didn't see it before, that's what I'm calling your attention to, is that little point up there at the top where the cost of living, the wholesale price index were flying off the charts, and then they made a right angle turn. And it's not just, so this is the cost of living index, this is the wholesale price index, this is what people were facing in the market, Germans, when they were trying to buy goods and services. This is the exchange rate with the US dollar at that same time. If you want to see a really hard 90-degree turn, that's a really hard 90-degree turn right there. The devaluation of the currency relative to the US dollar literally stopped within 10 days and backed up between November 20th and November 30th of 1923. It not only stopped, it backed up in 10 days. So let's go back to those conventional theories for the end of inflation and say, could any of them explain this way that the hyperinflation ended? Did the government just stop overissuing money instantly? Well, actually, while the government money printing may have been one of multiple causes of the Weimar inflation, it cannot explain the sudden stop of the hyperinflation, because the government actually continued printing money after that point. The money issuance grew by a multiple of 4 in the 3 months after the hyperinflation stopped in November. And it's important to remember that government money printing actually trailed inflation and private bank deposit creation for much of the hyperinflation episode. It was really a situation where the printers, literally, they had 1,700 printers on the job, could not keep up with the demand for payment media that was required to access the new bank deposits in the form of paper media. And just, I think I cut that slide, but there is a chart somewhere where you can see that the money supply is actually growing slower. It might be, let me see if I can go back and show it here. Yeah, you can see here that this is the hyperinflation period, and that this is the hyperinflation period. This low line right here, the lowest line, is actually the money supply, and it's trailing the inflation. Okay. So here's the thing: is that sorry, did I move the slide? I meant to move the slide here. Sorry. This is the money supply relative to the price indexes and the exchange rates. So you can see that the exchange rates and the price indexes are accelerating faster than the money printing. The money printing is trying to keep up. Okay. And of course, we already know that the conventional theories make no mention of money creation by private banks generally. Certainly no headline mention. It's not in the title of the paper, right? Whereas overissue is by the government, deficit spending, and so on. So what about credible expectations, right? We already know that this is a garbage theory, as I said earlier. But this is a quote from the governor of the Central Bank of Germany that oversaw this amazing couple of weeks period where inflation just stopped on a dime. And he says, the bank's action saved not only the currency, but also confidence in the currency. And this confidence was not based on tedious expositions of proof or exhortations, but was supported by the weight of action. And I'm going to show you what those actions were in just a second. But this is him writing in a memoir, essentially 30 years later, and saying, breaking down what they did and why it worked. The wage price spiral idea, well, actually, other people have looked at it and said, actually, it was an exchange rate devaluation price spiral. In that the devaluation of the currency was leading to higher prices for consumers. The consumers and the labor unions were having to go fight for higher wages, and maybe that led to additional price increases. I would say that it probably didn't. The devaluation was probably still what was outpacing the wage increases. But in any case, they have identified in this particular paper that it really was a devaluation price spiral. So let's look at some of those other 14 ways that inflation can be caused and ask, could they have stopped a hyperinflation on a dime? Could a change in them, right? I'm going to do this very quickly, but rising input costs, no. Wholesale prices continued to climb for a month or so afterwards, but slowing. The failure to invest, slowing quickly. They stabilized very quickly, but they did continue to climb for a moment after the exchange rate devaluation stopped on a dime and actually reversed. Failure to invest in production, like, no, there's no way an increase in production investment could have changed the situation in 2 weeks. A production disruption. Lots of people will say, you'll see things written like, oh, the France's and Belgium's invasion of the industrial region of Germany called the Ruhr in early 1923, I believe it was, caused the hyperinflation. It's like, well, first of all, there's lots of historians that disagree with that perspective. But secondly, production in Germany actually continued to climb despite that in 1923, and the Ruhr occupation continued well through 1924 when the hyperinflation had ended at the end of 1923. So this just doesn't explain it. Price gouging. There were monopolies actually in the German market, and that was a concern at the time, but no new measures to block price gouging were implemented in that 2-week period. And monopoly prices, sorry, I jumped ahead there, but you get the idea. Interest rate increases, there wasn't a big jacking up of interest rates at that time, or lowering of them, opposite. There wasn't a big change in luxury good purchases. Everything had become a luxury good. Nothing was affordable. And there wasn't a sudden shortage of financial assets relative to investable cash. The money supply, as I said, particularly the government money printing, grew nearly 4 times in the 3 months after the hyperinflation stopped. That, you could say, the central bank money creation. And now I'm gonna save these two for the next slide. But speculation, I believe yes. Devaluation of the currency, yes. High foreign debts, right? Oh, the government had a lot of foreign debt, so that's why. Well, actually, Germany had suspended making reparations payments long before November 2023, and when it resumed them at the end of 1924, hyperinflation did not return, right? So nothing changed about Germany's foreign debt, in the last 2 weeks of November of 1923. And a collapsing government. Believe it or not, there are papers that will actually blame the German government essentially for trying to survive and maintain its own currency instead of allowing, foreign currency to just take over, replace the mark, and, essentially lose its sovereignty. But that is not what was going on there. That is not what was causing the inflation. That the government was fighting to try and stay sovereign and have a currency. The whole legal infrastructure is still in place. Producers were still accepting it. Taxes were still being collected, etc. And most importantly, consumers and households and businesses were still using German marks. So what did change between the 17th and 30th of November 1923 when this miraculous hard stop of the foreign exchange devaluation came to a stop and reversed, and also the price indexes quickly stabilized. So most of what I'm going to tell you is coming from a particular account, which is by Hjalmar Schacht, but I'm also drawing in many other things that I've read. He was the new currency commissioner put in place on November 12th, and on November 20th, he became the president of the Reichsbank, which is Germany's central bank. So what did he do, or what did they do? There were multiple things, and he wasn't the only one involved, but one of the first things they did was stop speculation, particularly foreign exchange speculation. Banks were lending huge amounts of money to foreign exchange speculators that were essentially betting every day on the idea that the currency was going to continue to go down in value. Now, if you can see that there are huge amounts of bets on the foreign exchange in the Bourse in Cologne, right? Just like today, you've got exchange markets where forward prices are being predicted, where people are saying, this is how much I want to pay for currency today, and then there are other people saying, hey, here's how much I'll be willing to pay for it in the future. You can see that the bets are going one way. And if the bets are saying that the currency is going to be worth a lot less in the future, then even if you're doing legitimate business, you're not going to be willing to do an exchange today, when it's going to be worth even your exchange to be worth actually more in the future. And so anyway, it's kind of a self-fulfilling thing that happens where the currency starts all kind of building up on one side. And so the Reichsbank said, look, what's supercharging this is that banks are lending money for this speculation. And so they told them cut that out. And what's really interesting is that some banks ignored that prohibition in early 1924, and the central bank said, okay, well then we're just going to cut you out of the payment system, and we're also going to stop discounting your loans. And so basically, you're going to have to come back and beg us, please, to let you back in, which happened very quickly. They cut off something called emergency money, which is being used as a source of financing for foreign exchange speculation. And currency was made non-exchangeable. And the way they did this is essentially what's called a capital control, kind of by a roundabout way. The government issued a new currency called the Rentenmark, which was useless in foreign exchange. It was by design, it was useless for foreign exchange. It could not be held by foreigners. And so this short-circuited the foreign exchange speculation, which depended on being able to deliver marks to foreign entities. And then finally, they fixed, or not finally, but they also fixed the exchange rate, right? So the central bank refused to trade currency higher or lower than 4.2 billion marks per dollar, which is very interesting because after cutting off the foreign exchange, they could have allowed the value of the mark to actually free fall, or rather appreciate very rapidly. But instead, what they wanted was they just wanted stabilization. So they fixed the exchange rate at that amount and guaranteed it with their own purchasing and trading. And then the overissuance of money by private banks stopped. So they actually put in place credit controls, not just for speculation in the foreign exchange market, but also for other types of speculation. For 2 months, they even just cut off banks' privilege to create money entirely. And they, it's important to remember again that the issuance of government money actually continued during this time, just as, but they made an emphasis that Rentenmarks in particular could only be created and issued for bona fide industrial and government transactions, again, not for speculation. Okay, so what was the stabilization recipe there? It was capital controls, exchange. These are the technical terms for them. Don't worry about it. You don't need to understand each of these. I didn't use these terms as going through it, but just to say, capital controls, exchange controls, fixed exchange rates, payment system control, and credit controls, which is restricting the issuance of money by private banks in particular. And the reason we're talking about all of this is because those are exactly the things that monetary unions are for. Monetary unions are when countries come together and they agree that the way their currencies are going to interact with each other is going to be done in certain ways that protect or determine certain rights and privileges of the union members themselves. So I'll make this a little bit clearer. And you've got some examples there of Bretton Woods. So everything on the left of your screen is something that is almost always negotiated as part of the agreement of a monetary union. And take, for example, the Bretton Woods Agreement. And just to say, monetary unions are old. There's evidence of the ancient Greek city-states, having these types of agreements. There's the German monetary union of the 1300s. And then you've got more recent things like the Bretton Woods and the European Monetary Union that followed it, or that replaced it for European countries at least. There's an Asian initiative that's going in this direction called the Chiang Mai Initiative for Asian countries. But generally, just like in Bretton Woods, what countries are doing is they're getting together and saying, we're going to agree that the way our currencies interact with each other is not going to be used in a coercive way, so that countries have the privilege or the ability to do things like control the issuance of their currency, control the flows, the capital flowing in and out of their currency, control who it is that's able to do the exchange, that's exchange controls, control the exchange rate, and control the payment system by which that's happening. These are very common elements of monetary unions, and the purpose of them is to protect the sovereignty of nations from interference that is coming through the monetary mechanisms of currency exchange. So I'm going to have to stop before getting to some of the juicy stuff, which I thought would happen. But just to say that this is what could be a whole nother presentation. So I'm not going to break this down. I'm just throwing the slide to say this is what's can be a whole nother presentation, is what are the common elements of monetary unions? How do they fit into monetary reform, and why they are so essential, and why the historical evidence on that is so clear that they are incredibly essential for countries being able to maintain both control over their own monetary system, but also being able to control their economic system and their financial system. Yeah. All right. So.
Yeah, thank you, Sam. Am I audible? Because
yes, you are, Hobart.
Okay, that's good. That's good. How long for question and answer, Stephen?
Well, let's go 5 minutes and then maybe a few minutes extra.
Okay. I don't see anybody lined up.
I am. I got my hand. I got to look.
I got a quick question.
Hand up. Okay. But I'm going to take the privilege as moderator, so hold your horses. So about the Weimar inflation, Selenga wrote an article about that. Did you include that in your research?
Yeah, I didn't mention it here because there's just too much to cover at once. But yeah, it's very interesting that in the Reichsbank, which is the central bank of Germany, just like all central banks in the world at that time, was a privately owned for-profit corporation owned by banks. And interestingly, after World War I, the German government actually exerted control over that bank, and was using it to rebuild the country. And there was some inflation during that time for sure. Other countries, as Schacht points out, also had inflation going on during that time, and were similarly using monetary mechanisms to rebuild their economies. It was not important. It is important to note that it was not until the German government was compelled to essentially make the central bank independent that the hyperinflation took off. They were compelled to make them independent again, and basically set the central bank free to be run by bankers in March of 1922. And the first hyperinflation month did not start until July of 1922. And the whole thing ended in November of 1923, when some essentially loyal nationalist governors of institutions like the central bank were put in place, who said, "Wait a minute, we're putting a stop to what the banks are doing here," and
yeah,
kind of restored some.
Would you agree then? Because Salenga wanted to make the point that there's a danger in independent or private central banks, and that the whole story of the hyperinflation, to blame that then on the government, is certainly a myth in the case of the Weimar Republic, and it's actually the other way around. It was the intervention of the government that stopped, dead cold, the hyperinflation. But it was also Schacht, who was kind of seen as a monetary wizard. He stayed on quite long, but I think that's a reasonable summary of Selenga's position, and the way he used it for promoting monetary saneness. Mm-hmm. All right, Stephen, go ahead. And then we'll have Frans and then Nick, and we'll see how far it goes.
Yeah, real quick, because I want to get to the others, and I know Frans will go more international, what might be a future presentation for Sam here. I just wanted to make a real summation sort of point. where Sam's presentation fits into the larger picture this weekend. On Thursday, we covered two national bills in the U.S., the AMRA and the Greenbacks Restoration Act. And that was really solid work. I think we have the ideas from Millen and Samuel. And I think those are good operation ways of thinking of Samuel's scales. and Sam's work here, Hummel's work here, is a first step to really think about and learn. So that would be, if we develop a think tank and we develop homework for ourselves, step one is to go work with Sam here, get down the concepts, get down ideas, and then go towards Samuel's scales to build a system based on our work on Thursday. So this has been a great monetary period between Thursday and Saturday morning here. And I see a continuation, and Sam was wonderful. Last thing is, I thought Hover did Zarlanga well there. And Zarlanga had The Magic of Money, Schock's book, and he was a follower of that. And in both books, he looked at the one he wrote during the war and one he wrote, as you alluded to, in 1968 there. But thank you. I'm off.
Yeah, thank you. Okay, I'm calling on my compatriot Frans. Frans, go ahead. But I know you make bigger statements. Try to keep it slightly short, please. Hello.
No, first of all, I think that the presentation is an example of the way AMI and monetary reformers ought to go about, particularly doing historical research, etc. My question to Sam is, given that you are interested in monetary unions, to what extent do you think that your stabilization recipe can be useful in trying to get into an international monetary union where you would have a UN People's Bank with its own governors, etc., and where you would see the need to change the global governance system of a neoliberal capitalism or socialism or totalitarianism into a new one that really takes the non-extremist elements of those major global governance systems into account. And so I'm very much interested in talking to you later on, particularly given that you are a Duke and I'm here at Chapel Hill, about the whole issue of this needed international global governance system, which I call tyrannism, which would then integrate the non-extremist elements of the other global governance systems. So, given that your interest is in monetary unions, what about an international monetary union which has also as a requirement a new global governance system?
Yeah, that's a great question, Franz. So first of all, I want to distinguish between types of monetary unions, and we don't have a chance to get into that today, really, but the European Monetary Union and Bretton Woods, the European Monetary Union actually predated the creation of the euro currency by about 30 years. And the Bretton Woods system as well operated during a time of multiple currencies, right? So the European Monetary Union, every country in Europe still had their own currency for 30 years while that union was in place. During Bretton Woods, every country had their own currency while that union was in place. So a monetary union does not mean that everybody adopts one currency. It can be that way as the euro has evolved. I would say that is a mistake, and I think that it's the reason why I use currency federation in my original title, because I think that it's very important that countries, but not just countries. I mean, you can go down to any level of communal societal size that you want to, should have the ability to control how much or what type of money is coming in and out and making claims on the real human and material resources that belong to that community. Because that's what's happening when you have foreign exchange, is that, depending on which way the flow is going, you are potentially giving up control over your local human and material resources to some foreign entity. And why should local people not actually have the ability in all cases to make the determination about when they give up control over those local resources to some foreign entity? And if we're going to use monetary systems, then that means they have to be able to control monetary flows to do it. And so, I'm not a fan of a single global currency or even the euro. As far as global governance, though, I think it's worth noting how well the Bretton Woods Agreement actually worked in many ways. And we didn't get a chance to talk about that today, but I have a tour de force of evidence of how well the Bretton Woods Agreement actually worked in terms of protecting nations' monetary sovereignty, as well as their economic policy and fiscal sovereignty. And that didn't require a new global government, right? The United Nations was the umbrella under which it was negotiated, but the enforcement was provided by the members to the union themselves. It wasn't the United Nations, and so these unions need governance in the sense that someone has to be in control of the enforcement of the rules, but it doesn't need to be a national government that's also controlling a whole bunch of other things.
Yeah, in the interest of time, I simply will converse with you later on.
Great. Thanks, Franz.
Yeah, because simply for your and the others' information, in about 3 weeks, I will have a sequel to my 2012 book. And there I will argue for the need of to start strategically, to start with a justice-based monetary sustainability framework with its 6 applications in the 4 in the subsystems of the world economy, and then the world economy itself, and the global governance system. Because the way, and that is also the shortcoming of Bretton Woods, is that it is really based upon a liberal capitalist system, which of course is strongly attacked by China and many others, also many African countries. So what we are talking about here is really a major tipping point. And so the name of this sequel book is called The Tierra Tipping Point, shifting from cryptocurrencies, bank money, shadow bank money, to the digital currency of a UN People's Bank. And so there we would have one. That's one possibility. You can, for historical reasons, also people can maintain their currency's name, but in terms of value, the value is going to be the level of decarbonization of a society's economy.
Okay. I mean, but Franz, let me jump in as moderator, and I think we lost Hobart, and we need to move on. Nick, we have to save your question too. I'm sorry. We're 10 minutes into this period already. We only have.
I don't have a question. I just have a request that Sam write about this so that everybody can benefit from it. I really think you need to write a paper or a book about this. And that's all. I had no question. I really appreciated the presentation.
Thanks, Nick. I think for Franz, just keep the thought in mind to stay positive. In the way that Germany had too little monetary flows, the Rentenmark, maybe we can put it in Sam's imagination now to think about too little specialized little flows of money internationally, maybe. A national money plus some international special drawing rights, Banco or whatever. But I leave that up for you guys in the future. Sam, thank you very much. You've put in a lot of food for thought, and it's all fantastic. We can't thank you enough, and we look forward to hearing more from you. And I look forward to seeing us carrying forward. And we're cheerleaders for your work. So thank you very much, Sam.
Thank you, Stephen. And if folks would be interested in a follow-up presentation on the monetary union framework, I'd be happy to provide that sometime.